Hi, Lee Phillips here. I'm going to talk to you about a question that I get pretty often, and that is, how do you get money out of your company? Well, that makes an assumption. The assumption is you have money in your company. You can get it out as a wage, that's fine. You pay yourself W-2 income, you pay the Social Security, FICA, FUTA, the employment tax, all that crap. That's 16% today, and it goes up every other day. Maybe with Trump it'll go down, I don't know. But you pay the self-employment or the employment taxes, and if it's just you and you're doing it as yourself, sole proprietor, you pay the self-employment tax. Same difference. But at any rate, so you can take it out as a wage, but that's the haircut off the top, 16% or whatever it is. So how do you get money out of the company? Well, you take it out as a dividend. No, that's a C corporation. Now, you can have an LLC that's taxed as a C corporation, and so it's the same thing, but it's taxation under Chapter C of the IRS code. And the only way you can get money out of a Chapter C taxed entity, corporation or LLC, is to either pay a wage or to pay the dividend. But the dividend is double taxed because the company itself pays tax. It does not get a deduction when it pays the dividend to you, and then you take the income or the dividend as income and you pay income tax on it. So it's double taxed. Don't let anybody ever tell you that corporations, C corporations or LLCs taxed under Chapter C of the IRS code don't pay tax. By the time you pay the dividend and get it out, it's like a 70% tax loss. It's huge. So you go to Subchapter S. Now, why would you use Subchapter S? Well, use Subchapter S if you're selling goods or services. Basically. Because you can take, under the law, a reasonable salary. That's the W-2 stuff. You have to pay the employment tax. Then whatever's left above that, you can take out not as a dividend, but as a distribution. That distribution comes to the owners. It goes pro rata based upon your ownership, and it goes down as a distribution. It's not earned or active income. It's passive income. You don't pay the employment taxes on it. That saved you 16% right off the top. Now, if you're getting your money through rents or royalties or something that we would call passive or unearned income, then you're going to be taxed under the partnership structures. Get an LLC, that gives you the asset protection. We do other YouTubes on that. But you get the LLC and you have it taxed as a partnership or even a sole proprietorship. They call it a disregarded entity. That way, all of the money in that passes through to you as passive or unearned income, and there's no employment tax. So you get all of that out, it comes to you, you get your K-1, and you simply declare it as income. You pay income tax, but not Social Security, FICA, FUTA, and all that garbage on it. So it saves you a ton of money. Now, I've either paid myself a salary, or I've dividended it out, or I've gotten it out in a partnership under a K-1 as passive income. Now wait a minute. I didn't have the partnership if I had earned income, and you get earned income by selling goods or services. I had the partnership or the sole proprietorship, the disregarded LLC, if I had passive or unearned income. So kind of remember those two. The way I like to get money out of a company is to expense it. As a little company owner, you have a ton of opportunities. You can expense all sorts of stuffs. Your cell phones, your computer, write off the mileage in your car. Some people put the whole car in the company, and you can do all sorts of stuff on that. But you have lots of opportunities. You can go to the convention in Hawaii. It's a business purpose. You can write off at least a chunk of the trip. And I've got a set out called Advanced Tax Tactics. You can look it up. It's on the internet. And I give you 10 ways that you can get money out of the company, and we can get big chunks of money. We're talking tens or even hundreds of thousands of dollars. Because anything that you take out of your company as an expense lowers your adjusted gross income. It's all what we call above the line. And I've got other YouTubes on this accounting stuff, above the line, below the line. But you need to control your taxes. And your company is your tax shelter. You've never had anybody tell you that. Your accountant doesn't tell it to you. The guy that set it up, the lawyer that set it up, he didn't tell it to you. It's your tax shelter. Learn to use it. Every time you do anything, you think, can I do this with my company? And what is the tax consequence? So, we're going to expense stuff. It isn't how much money you make, it's how well you live. We're going to expense stuff. We're going to take it out as a distribution, or we're going to take it as a salary. Those are basically the ways that you get money out of your little company. And little companies are great things if you know how to use them. Advanced Tax Tactics teaches you how to use them pretty well, actually. Or, I've never mentioned this on a YouTube, I do a 2-day event where I bring a dozen people in, well, a dozen couples, okay? Sit you down with a former IRS special agent auditor, myself, another attorney, and a financial dude, and we teach you about asset protection and how to control your money. Not selling you anything, just giving you the foundation, the legal foundation to work with. Because your company is a legal foundation. It's a structure. And how you use it makes a huge difference. This is Lee Phillips talking about how you get money out of your little company.